Welcome back to Finance in Motion. My name is Adamo, your personal financial planner. As always, my goal is to help increase your wealth and help you sleep well at night. In today's video, I'll be speaking about a concept called the dangers of bank insurance. So I'll go through an example, as you see on the board, which is always pretty full, but I'll go through each situation. And the point of this video is to really demystify and explain the process of buying insurance from a traditional insurer versus buying it from the bank. So as always, I talk about the issue, the action, and the result. And you'll see as I go through the example how it'll clearly bring to life the pitfalls and dangers of buying your insurance at the bank. So what is the issue in the situation? So this example would arise when someone buys their first home, when they buy a second property, and you sign the mortgage at the bank, and the bank asks you if you want to buy the life insurance, disability insurance, or critical illness coverages via the bank's products. So there's a few issues with doing that process. So the question that arises from this need is, where do I buy my mortgage insurance? So we've heard about mortgage insurance, bank insurance. Those are all euphemisms for and interchangeable terms for insurance that protects your mortgage in case of death, disability, or critical illness. Okay? So in the example that I'm talking about, so you sign for your mortgage and you will typically just sign for the insurance because you want to get your mortgage and you want to be able to move into your home and get the whole fun process started. The issue comes into the definition of what is mortgage insurance at the bank. Are there issues, pitfalls that can arise from purchasing the product at the bank? Okay, so this little table explains the pros and cons of bank insurance versus a traditional insurance with any large carrier that you can think of. So I'll go through each point and it'll help clarify the potential risks associated with bank mortgage insurance. So at death, who gets paid? So if there is a death, who gets the money in the situation where if I bought my insurance at the bank or if I bought it with a traditional insurer? So at death, the bank would get the money. So if you had in mind to give the death benefit to a spouse, to your children, and for them to then sell the home or do with it what they want, they don't have that luxury. So in this situation, the bank would get whatever the amount of coverage is or capital is, and then your home is paid. So it's good, it's better than nothing. However, the issue here is that the bank has the control to pay themselves first and not your beneficiary in choosing what they do with that money. Whether with a traditional insurer, your beneficiary gets 100% of the capital and they can decide what they do with that money. Okay, so they could pay off the mortgage, they could just pay the monthly payments with that money, they can invest the money and create profits and help pay for the monthly mortgage. There's a whole plethora of options at your disposal when you have control. Okay, so the next point is how much is paid of that mortgage balance or mortgage insurance. So at the bank, it's the mortgage balance. So at first glance, that might not seem so bad, but if you're looking a little bit deeper at an example, you can see how perilous this can be. So if you imagine you've been paying your mortgage for 15 years and you have a 25-year amortization or length of your mortgage and a death occurs. Well, you've been paying an amount for your initial mortgage in terms of the insurance, but at death, only the mortgage balance is paid. So if you had $50,000 left out of a $250,000 mortgage, well, that $50,000 is what will be paid to the bank to pay off the loan. However, versus a traditional insurer, it is always your initial amount. So you will always have the $200,000 of coverage throughout the term of the mortgage and the term of the policy. Much more advantageous to have the initial amount. Okay? The third point is, can the premium rise? So at the bank, when you purchase the product through the bank, yes, it can rise. How? So if you work with a mortgage broker and every 5 years you change bank because you have a better opportunity for a better rate elsewhere, well, you need to requalify for insurance every time. Well, guess what? You're older every 5 years and you may have medical issues that can create a surcharge or an increase in the premium. Versus getting it through your traditional insurer, you buy a 20-year term, for example, the premium will always be the same and it'll always be fixed throughout that term. Of course, That's assuming we don't make any changes to the coverage. So big difference in the premium rising. The premium calculation. So at the bank, the way they calculate that premium is via all the bank's clients. So old people, young people, sick people, healthy people, and they come out with smokers, non-smokers, I might add, and they come out with an overall premium. Now, this may be good for somebody who's a little bit older and not healthy at first glance. However, you quickly notice that the cost, whether you're healthy, young, old, smoker, the price is generally much higher than a traditional insurer. Okay? The premium calculation on the traditional insurer is based on you and you alone, your health, your situation. So in most cases, you want the underwriting or the premium calculation to be based on you alone. Okay? The next point is, can the bank choose not to pay you? And for me, this is a huge point of contention. You purchase this insurance, you buy a mortgage based on the home that you purchased, you do all the right moves, thinking that you're covered and you're protected, all to find out that the day there's a claim on death, disability, or critical illness, depending on which products you have, the bank starts the verification of your file, the underwriting of your file at the time of a claim. So yes, they can choose not to pay you if they uncover any pre-existing medical conditions, anything that you didn't mention at the time of the application, because when we do apply for a bank product, it's a few questions where you answer yes or no, and you think you're insured. So how does that compare with traditional insurance? Well, the traditional insurance, if we were honest at the beginning of the application, if we did not commit fraud or omission of information, if we went through all the underwriting or verification in our file that the insurer asked for, there is no reason why the insurer wouldn't pay. Okay? The only exclusions that exist in an individual contract are suicide first 2 years, any fraud committed in the application process, which is obvious. If we join the military, join any active war, any criminal offense, or any driving under the influence, all logical and obvious reasons for increased risk. That's not the responsibility of the insurer, and actually is a responsibility of the insured. Okay? But this point here, can the bank not pay you? Huge point in determining why you should most likely buy your insurance to cover your mortgage and all other insurances through a traditional insurer and not through your bank representative. Okay? The last point is the price. How does the price compare? So by and large, in our studies, we see that the traditional insurer, the cost savings is about 25% cheaper than the bank insurance. And you might ask yourself, well, why is that? It's absolutely because of the premium calculation, which is based on all the bank's clients, versus in a traditional insurer, it's based on your health. So we typically see, on average, about 25% in savings in terms of the premiums. So depending on how much you're paying, if you do have bank insurance currently, you can replace it by going with my second point, which is your action. So we as financial planners in our practice always suggest that you work with a broker. Why? Because a broker does not get paid until they find the coverage that suits your needs and suits your overall budget. So they can compare what you have at the bank, what you need overall, what your budget is, and basically find you a coverage that is typically cheaper and has better definitions overall. So if there is a claim, you can sleep well at night and know that you will be protected and that the payment will be effectively made to your beneficiaries upon a death, or to you upon a disability. Okay? So overall, you kind of see where I'm going here, in that in the absence of understanding this information, a bank insurance is better than no insurance, because at least we have the potential to be paid out in case of a death, illness, or accident. However, armed with this new information, by and large, it is much better to go with a traditional insurer and to shop with a broker to do so. Now, some of you might ask, well, what if I have some health issues? What can I then do? With a broker, they can look at traditional insurers, or they can look at insurers that will not ask you any medical questions, called non-medical insurance. Okay? So there are different options when working with a broker. medical, non-medical, and they have the entire market available for all clients. Okay. The other thing is that once you buy your traditional policy with a traditional insurer to cover your mortgage, if you change banks with your mortgage over time, the policy and the insurer does not care where your mortgage is because they are not linked. So every 5 years, if you do change bank because you're working with a broker, it is independent of your insurance policy. So you have no changes to make to your insurance policy. It just stays in force. The same premium is paid because we did not touch that coverage. The result in the end is essentially that you have peace of mind knowing that you apply for your traditional policy, you're covered, and that you know that they will pay in the future in case of one of the events happening, primarily death. And there's by and large some savings in terms of the premium being cheaper. So I hope this example showed the potential dangers of traditional bank insurance and the options that you have at your disposal by going with a traditional insurer through a broker who will shop the market for you and find the coverage. Once you have your coverage, you can easily then cancel your bank insurance and definitely have more peace of mind and use that savings to contribute to your RSP, contribute to a tax-free savings account, pay down debt, or enjoy a vacation. Do with it what you will. But if you think about what you're currently paying on your mortgage insurance, take a look at your documents and you'll be surprised to see that there's some very interesting cost savings to be had by simply going through this exercise and replacing that policy. So once again, thank you for watching this video. If you enjoyed this video, please like it and don't forget to subscribe to the channel below. And as always, have a great day.